Hello, and welcome to Boni's Life, the channel that helps you make sense of the financial world. Today, we're diving deep into a topic that's been on everyone's minds: the Federal Reserve's recent interest rate decision. What does it mean for the stock market? How is the crypto world reacting? And most importantly, what does it mean for your money? We'll break it all down, giving you the insights you need to navigate these changing economic tides. So, grab your coffee and let's get into it. First, let's talk about what actually happened. On September 17th, the Federal Open Market Committee, or FOMC, announced they were cutting the federal funds rate by a quarter of a percentage point. This brings the new target range to between 4.00% and 4.25%. Now, for those of you who don't follow the Fed's every move, this is a big deal. It's the first time they've cut rates in 2025, signaling a potential shift in their monetary policy. So, why the change of heart? The Fed's statement pointed to a few key factors. They noted that economic growth has moderated in the first half of the year. Job gains have slowed down, and while the unemployment rate is still low, it has ticked up slightly. Inflation, which has been a major concern, has moved up and remains somewhat elevated. But the real kicker seems to be the downside risks to employment, which the Fed now sees as having risen. In plain English, they're a bit more worried about people losing their jobs. Now, was this a surprise? Not really. The market had been anticipating a rate cut for weeks. In fact, according to CryptoQuant's head of research, Julio Moreno, the market was seeing a 25 basis point cut with above a 90% probability. So, the decision itself wasn't a shocker. What was interesting, though, was the internal debate. The vote was 11-1, with one new governor, Stephen Miran, actually wanting a more aggressive half-point cut. This tells us there's a range of opinions within the Fed about how to handle the economy right now. So, if the rate cut was expected, you might think the market would have had a clear positive reaction. But that's not quite what happened. Wall Street's response was, well, a bit wobbly. Initially, stocks did get a little boost. But as the day went on, the major indexes ended up mixed. The Dow Jones Industrial Average actually closed up gaining about 260 points. But the S&P 500 and the tech-heavy Nasdaq both slipped a little. It was a classic case of buy the rumor, sell the news. The bond market had a similarly indecisive day. The yield on the 10-year Treasury note, which is a key benchmark for things like mortgage rates, initially dropped. But then it reversed course and ended the day higher. This is interesting because it suggests that bond investors aren't convinced the Fed is going to go on a major rate-cutting spree. If they were, you'd expect yields to fall and stay down. So, what's with the mixed signals? A lot of it comes down to Fed Chair Jerome Powell's press conference. He described the rate cut as a risk management move, not a response to a weak economy. That's a subtle but important distinction. It suggests the Fed is trying to be proactive and get ahead of potential problems, rather than reacting to a crisis that's already here. But it also leaves investors wondering what comes next. The Fed's own projections show they expect to cut rates 2 more times this year, but Powell was careful not to make any promises. This uncertainty is what led to the choppy trading we saw. Now, let's turn to the world of crypto. How did Bitcoin, Ethereum, and the rest of the digital asset space react to the Fed's move? Well, much like the traditional markets, the immediate reaction was pretty muted. Bitcoin, for example, was trading in a tight range between $115,000 and $117,000. We saw a little volatility with Ethereum, but nothing dramatic. So, why the calm? As we discussed, the rate cut was largely priced in. The crypto markets, which are becoming increasingly sophisticated, had already factored in the high probability of a 25 basis point cut. But don't let the short-term quiet fool you. The mid-term and long-term implications for crypto are significant. A lower interest rate environment is generally seen as a positive for risk assets, and that includes cryptocurrencies. When the return on safe haven assets like bonds is lower, investors are more likely to look for higher returns elsewhere, and that can mean more money flowing into crypto. We're already seeing some interesting signs. The Altcoin Season Index, which measures the performance of altcoins relative to Bitcoin, has hit its highest levels since December 2024. This suggests that we could be on the verge of a new altcoin season, where smaller cryptocurrencies see significant gains. We're also seeing a downtrend in Bitcoin's dominance, which further supports this idea. And then there's the world of decentralized finance, or DEFI. With traditional yields coming down, the attractive returns offered by DeFi protocols could become even more appealing to investors. We're already seeing record amounts of money flowing into DeFi, with the total value locked recently hitting $41.5 billion. A more accommodative Fed could pour even more fuel on that fire. Of course, it's not all smooth sailing. The crypto market is still sensitive to macroeconomic factors, and any unexpected moves from the Fed could cause volatility. And as always, regulatory developments are a key factor to watch. But for now, the Fed's dovish turn is being seen as a tailwind for the crypto space. So, with all this information, how can you, the savvy investor, navigate this new landscape? What are the key triggers to watch? And what are some potential strategies to consider? Let's break it down. First, let's talk about triggers. The most important thing to keep an eye on is the economic data. The Fed has made it clear that they are data dependent, so their future decisions will be guided by what the numbers are telling them. The big ones to watch are the employment reports, inflation data like the CPI and PCE, and economic growth indicators like GDP and consumer spending. Any surprises in these reports could lead to a shift in the Fed's thinking and a significant market reaction. Another key trigger is the Fed's own communication. Pay close attention to speeches from Fed officials, especially Chair Powell, and the minutes from their meetings. These can provide valuable clues about their future intentions. And of course, keep an eye on market volatility. The VIX, often called the Fear Index, can be a good indicator of market sentiment. Now, for strategies, in the stock market, a lower interest rate environment can be a tailwind for certain sectors. Cyclical stocks, like banks, home builders, and materials companies, often perform well when the economy is expected to strengthen. Tech stocks can also benefit from lower rates, as it makes their future earnings more valuable. However, as we saw with the Nasdaq's recent dip, it's not always a straight line up, and in the crypto space, the strategies are a bit different. With the potential for an altcoin season on the horizon, some investors might consider rotating some of their holdings from Bitcoin into promising altcoin projects. Dollar cost averaging, which involves investing a fixed amount of money at regular intervals, can be a good way to build a position in major cryptocurrencies like Bitcoin and Ethereum without trying to time the market perfectly. And for those of you who are more adventurous, the world of DeFi offers a range of opportunities, from yield farming to providing liquidity. But be warned, these strategies come with higher risks, so it's crucial to do your own research and understand what you're getting into. Ultimately, the right strategy for you will depend on your own risk tolerance and investment goals, but by keeping an eye on the key triggers and understanding the potential implications of the Fed's moves, you can put yourself in a better position to succeed. So, there you have it. The Fed has made its move, and the markets are still trying to figure out what it all means. What's clear is that we're entering a new chapter in the economic story. The era of aggressive rate hikes is over, and we're now in a period of more accommodative monetary policy. But as we've seen, that doesn't mean it's going to be a smooth ride. There will be bumps along the way, and it's more important than ever to stay informed and be prepared. For the stock market, the road ahead is likely to be a bit choppy. While lower rates are generally a positive, concerns about slowing economic growth could put a damper on things. It's going to be a stock picker's market, where focusing on companies with strong fundamentals will be key. For the crypto world, this could be the start of an exciting new phase. The combination of a more dovish Fed and the ongoing innovation in the space could create a powerful tailwind for digital assets. But as always, crypto remains a high-risk, high-reward asset class, so it's crucial to invest responsibly. So, what's the bottom line? The Fed's rate cut is a significant development, but it's just one piece of a much larger puzzle. The best thing you can do is to stay educated, stay diversified, and stay focused on your long-term financial goals. Don't let the short-term noise distract you from what really matters. That's all the time we have for today. I hope you found this deep dive helpful. If you did, be sure to hit that like button, subscribe to Boni's Life, and ring that notification bell so you never miss an episode. And I want to hear from you. What are your thoughts on the Fed's decision? Are you bullish on stocks? Are you diving into crypto? Let me know in the comments below. Thanks for watching, and I'll see you next time.